Good afternoon, everybody. Welcome to my video update. Today is Wednesday, April 3rd, 2013. The first thing I want to do is congratulate everybody on a successful and profitable first quarter. We've seen very nice gains, and let's hope we can keep them throughout the year. One thing I've always said is it doesn't really matter what you make in the market, but it does matter what you keep, and that really goes into the theme that I'll be talking about today. And that theme being 5 reasons that I think we need to be really careful with the market. I do expect to see a pullback, and I'll get right into those 5 themes now. The first one being the Dow Transports. For those of you who follow the technicals in the market, the Dow Transports led the market higher in the first quarter, and it's starting to break down. One of the issues here could be slower growth. For example, FedEx announced earnings, and they were not very good. I'm sorry, the earnings were very good, but their guidance was pretty weak, and it was lower than the street expected. When we hear things like that, we need to be very careful. Caterpillar as well, and I know I've talked to everybody here about Caterpillar many times. Their guidance was the same, and we need to be careful. The second thing I want to talk about is gasoline. Today it was crazy. I think I paid $3.91 at the tank, and I felt like they were giving it away. That just shows you how crazy gas prices are right now. But if you remember back to 2008, when we talked about gas prices and how they were, at $147 a barrel, and when they finally went below 100, people said this is great for the stock market. This is great for the consumer because people have more money in their pockets. One thing that we did forget was that there wasn't the demand for it. Now, right now, gas prices are high, and they did get to 147 in 2008 due to a lot of speculation. However, though, right now prices are elevated for demand purposes and supply and demand purposes, as also so much money printing going on here, and the fact that commodities are valued in U.S. dollars. The more money we print, the higher commodity prices are going to go. But if gasoline prices continue to fall, it is a sign of weakness, and we need to be careful about it just to keep an eye. It's something we'll be keeping an eye on. The third thing is Europe, and I don't have to say much when it comes to Europe. When you have half a continent that works for the government and the other half doesn't want to pay taxes, well, there's your problem. Okay, it's not anything out of normal. It just comes down to math. They don't have enough revenue. The fourth thing, which is really important, I want to focus on a little more, is the bond market. Right now, as the S&P 500 is getting closer to all-time highs, we're watching the 10-year go below 2% again. Now, the last time the S&P was at this level, the 10-year bond was over 4.5%. Right now, it's at 1.82 or so, around that area. A lot of this is due to the quantitative easing, but there's an old saying that says the smart money is in the bond market, and that's what you really need to pay attention to. One of the really excellent economists that I follow is a gentleman named Lacey Hunt, and he's been dead on with the bond market the last couple of years. And one thing that he is still saying is that the value of bonds is still going to increase, which means that yields will go down much lower. Right now, the 30-year bond is at, I believe it's like 3.4%. He doesn't think there'll be that great rotation from bonds to stocks until the 30-year bond hits 2%. That's a really long way to go right now, and but who's to say who's right or wrong? When he was predicting the 10-year at 2% a couple of years ago, people thought he was crazy, and look where we are now. So the bond market right now is not believing that the stock market rally is going to continue much longer. And then finally, number 5, the investor, the average investor. There's no fear. Okay, and when there's no fear, you need to be fearful. Okay, when people are really scared, it's a great time to get in. In an article by a fellow, Professor Hussman, who's a excellent money manager, he said that there's been 3 times where we've had the market euphoria we have today. The first time was April 2010, the second time was May 2011, and the third one being April 1st, 2013. Every time we've had this kind of euphoria with the data to back it up, the market has fallen an average of 18% in the next quarter. Now, are we going to fall 18? Are we going to fall 10? Are we going to fall 30? Nobody really knows. Maybe we won't fall. Maybe we'll just have a little correction to 2 or 3%. I'm not going to try to make that prediction right now, but I am saying we just really do need to be careful careful, and that is something we're going to do. I do expect to be taking some profits off the table because, like I say, it's not what you make, it's what you keep. I do believe we'll have better buying opportunities to buy the same exact assets again at lower prices, and that time could be coming sooner than later. With that being said, please contact me with any questions, and as always, I'll be acting on your best behalf, and thank you so much for being my client. Have a great day.